Welcome to the third webinar in the Fintelekt and Asian Bankers Association webinar series for 2019. I'm Shirish Pathak from Fintelekt, and I'm happy to be your host for the webinar today. To begin with, let me thank the Asian Bankers Association for partnering with us in this important initiative, which we believe will help increase awareness of AML CFT related issues within the Asian region. For those of you who don't know much about Fintelekt, a quick introduction. We are a company focused on research, training, and advisory in AML CFT based in India and operating across Asia. The Fintelekt Certified AML CFT Professional Training Program is gaining popularity across the region, with hundreds of banking and compliance professionals being trained and certified over the last few years. And for those of you who do not know already about our upcoming Asia AML CFT Summit in Vietnam in September this year, do visit summits.fintelekt.com. This promises to be an informative and insightful event with speakers representing the Asia Pacific Group on Money Laundering, the Egmont Center of FIU Excellence and Leadership, the Royal United Service Institute, Liberty Shared, Australian Strategic Policy Institute, and a number of FIUs across the region in attendance. You will find more information about this event in the download section on your webinar screen. Today's webinar will focus on customer due diligence challenges and best practices, and I'm delighted to share that we have a broad range of expert speakers who will cover this subject from various angles based on their experience and current responsibilities. So the key speakers that we have today in order of appearance are Catherine Chiong, Deputy Head of Regional Compliance, Ascent Money, Thailand; Saurabh Nagar, Regional Manager, Business Solutions Group, APAC, Accuity; and Dr. Srinivas, Yanamandra, Chief of Compliance, New Development Bank, China. You can see detailed profiles of the speakers in the download section on your webinar screen. The format for the webinar today is interactive in the sense that I will pose a few questions to each of our speakers today, and they will share their thoughts on the subject. At the end of the webinar, we will take questions from the audience, so do type in and submit your questions in the box provided as the webinar progresses. Let me start the session by inviting Catherine Chiong, Deputy Head of Regional Compliance, Ascent Money, to share her views. Kathy, as a fintech based in Thailand and expanding rapidly across the Asian region, what would you say are the customer due diligence challenges that you are faced with, especially considering that financial inclusion is one of the objectives of Ascent Money?
In countries where True Money, a brand operated by Ascend Money, has a presence in, our target market is the unbanked and underserved population. With this target market, it comes with major challenges in conducting customer due diligence. The common challenges include lack of identification document or ID of the customer, especially our remittance customers in the rural areas where most of the people do not have valid or government ID or national ID. In some countries that we operate, the AML regulations require 11-point information as a minimum KYC requirement. For example, Philippines. And most customers are not willing to provide all their personal information, thereby making it difficult for us to perform name screening and risk scoring or profiling. In some cases, customers provide fictitious information or not able to provide beneficiary or beneficiaries information. For our remittance, cash in and cash out services, we leverage on our agent network, and most of our agents are mom and pop shops who may not be properly trained or have the same level of understanding of money laundering and terrorist financing risk, or who may not care about AML compliance and complying with company KYC procedures, even if sufficient AML training was given. In most countries like Cambodia, Myanmar, Indonesia, Philippines, and Vietnam, there is no central repository for the national ID or government IDs, making it challenging for us to validate the authenticity of the identification documents provided by the customers, especially our e-wallet customers. Lastly, in some countries, the AML regulations still require face-to-face KYC validation, which may not be practical operationally for our e-wallet business.
Kathy, considering the aggressive growth phase that your company is in, how do you ensure that the organization gives AML compliance the importance that it deserves?
As our True Money entities in all 6 countries are directly or indirectly regulated by the central bank, our company is cognizant of the regulatory risks as well as money laundering and terrorist financing risks. Our company has invested in hiring the right compliance professionals to focus on the effective implementation of AML compliance program. So we have a compliance team in each country that we operate to ensure we have compliance professionals or experts on the ground who can provide guidance, training, and advisory support to the business. A regional compliance team was also established to support the country compliance teams in implementing the right tools and processes to ensure that True Money is able to mitigate money laundering and terrorist financing risks. Our company also encourages collaborative projects among relevant business units like compliance, risk, product, marketing, and operations to be able to resolve AML-related issues.
Kathy, as you know, the regulatory focus in this area is still evolving. How can fintechs ensure that they stay ahead of regulatory expectations and the compliance curve?
Around the world, we've seen many countries have taken the initiative to set up regulatory sandboxes in the past few years, allowing different players in the financial ecosystem to test new solutions. This gave our company opportunities to work closely with the country regulators and partner with them to find ways to be able to build the right infrastructure and implement digital financial systems that are accessible, reliable, secure, affordable, and profitable. Regulators like Bank of Thailand, Central Bank of the Philippines, and State Bank of Vietnam allow financial institutions and fintechs to experiment and roll out products and services under a more relaxed regulatory framework, but within a well-defined space and duration agreed with the central banks, and in most cases, in a live but limited environment. We are fortunate as well to have the opportunity to engage with the regulators in the bilateral sharing, which will help shape a more practical regulatory framework in the future. While the digital payments regulations in Southeast Asia are indeed progressive, it will augur well to provide a degree of flexibility without fear of legal sanctions. It may also shorten the time to market and help Southeast Asian countries vault ahead in the digital evolution.
Kathy, finally, can you share any good practices that your company has incorporated in the KYC and due diligence area with banks and fintechs across the region who are listening to this webinar?
Unlike banking businesses, TrueMoney offers an e-wallet app which provides digital financial services to a wide range of consumers throughout Thailand and across other 5 countries in the Southeast Asia region. We aim to be a part of the customer's digital lifestyle by providing best customer experience to our customers, starting from the registration point to the customer's financial usage. To enable the best journey on our app, only required information or action should be requested from the customers, yet every feature that has been implemented needs to be completed by the customers in compliance with related laws and regulations. To consider how intensify the due diligence we should apply to a customer, we've categorized the customers by his or her risk level or profile. The more risk the customers are ranked, the more intensified the due diligence procedures will be applied, especially for the high-risk customers. One of this recent year's challenge for KYC in Thailand is the case of some people using other people's national ID card to open financial accounts. Bank of Thailand then has encouraged financial institutions, including e-wallet businesses, to consider implementing biometrics technology as part of their KYC due diligence journey, which would become a new standard for account opening in the future. TrueMoney, a regional fintech company, has implemented various advanced technologies into our app. eKYC biometrics, or the facial recognition or face matching, is one of the technologies taking part to make the KYC or due diligence journey of our customers easier and smooth while aligning with the laws and regulations. The security measures were also embedded in the app or KYC procedures to ensure the accuracy of the facial recognition, balanced with providing best customers experience by the inclusion of this feature. For example, the calculation and tuning up of accuracy rate and ratios of true acceptance rate true rejection rate, false rejection rate, and false acceptance rate. Currently, True Money customers can simply go to the designated points or venues to do eKYC biometrics by just bringing their mobile device, which has the installed and registered True Money wallet app, and a valid Thai national ID card. While the customer's data has been transmitted and stored securely throughout this process, under the customer's consent and in compliance with regulations, the data could also be analyzed to find the proper, favorable products to be offered to the consumers, giving them access to innovative financial services and leading to better lives according to our company's mission. In countries where we do not have the e-wallet product yet, like Philippines and Myanmar, we've initially used paper forms for collecting KYC. However, we have observed that most of our agents do not check if customers filled out all the fields. As a solution and to require agents to comply with KYC procedures, we have launched eKYC in our agent app. It's a tool used by our agents to process the financial products and services. Agents will not be able to transact remittance for our customers without collecting the required personal information and capture the photo of the customer ID first. We've seen a decline in the remittance transactions though for the first few months of the launch or pilot. This led to an opportunity for TrueMoney to strengthen even more the AML training and awareness program, not only for our employees, but for agents and its customers.
Thank you. Thanks for those insights, which I'm sure will be very beneficial to our listeners. Let me now invite our next speaker, Saurabh Nagar, Regional Manager of Business Solutions Group APAC at Accuity, to share his thoughts. Saurabh, at the outset, could you outline the key trends and transformative changes in the area of customer identification and monitoring in Asia?
Thanks, Shirish, for the question. Uh, in order to answer this question, I would like to first draw our attention to the regulatory, political, and compliance environment that we are living in today. Now, last few months, we have witnessed an aggressive trade war between the US and China, and the tensions between US, Iran, and US and North Korea are also growing. Now, these events have brought in with themselves uh, greater complexities and uncertainties, especially relating to trade. And in effect, we see greater scrutiny by regulators in this area, especially when we talk about Hong Kong and Singapore from the APAC perspective. This has also brought in new complexities which require financial institutions to not only have a KYC CDD or identification of their own customers or direct customers, but also to identify indirect customers. Uh, and what I mean by indirect customers are, for example, identification of beneficial owner of a particular vessel which is being used in a trade, and even tracking the journey of a particular vessel. And this will continue to grow this year. We also now see financial institutions doing KYC and monitoring on domestic transactions in certain jurisdictions. In fact, we have helped some of our customers in countries like Australia and China, for instance, execute this using our tools and expertise. Now, the challenge with this new trend or challenge with monitoring domestic transactions, you can imagine, is the sheer volume of transactions that we're talking about. With the penetration of smartphones, the success of fintechs, fast payments, the volumes have exponentially increased, and it requires a new approach, both from a technology as well as process standpoint, to be able to monitor efficiently and effectively. Now, and we believe that this trend will continue as well. Now, the third image here is, relating to artificial intelligence, machine learning, and all the new technologies that we hear in the market these days. Uh, no surprise that these technologies are getting popular, especially machine learning and blockchain. Also because a lot of large banks and regulators alike are experimenting with it. Some of them having success as well. Um, Now, with the growth of volumes and the search for a less manual and more accurate process, um, we will continue to see huge investment in these upcoming technologies because they are promising. And at Accuity, we are also investing in this area as well to help our customers. Now, last but not the least, as you just mentioned, the rise of smartphones and the internet, users, and the success of fintechs, and at the same time, a need to have greater financial inclusion at affordable cost. This has given rise to digital-only banks, or they are also known as virtual banks. In Asia Pacific, Hong Kong started this last year when they announced they'll be, HKMA announced they'll be giving out licenses for virtual banks. And MAS recently, a couple of weeks ago, announced their intent to give out five such licenses. So it's exciting times ahead, but at the same time, regulatory environment maintains its complexity and uncertainty.
Thanks, Saurabh. In your experience working with banks across regions, what would you say are some of the significant KYC and due diligence challenges you encountered, and how are you as an organization helping banks to counter these challenges effectively?
So, in order to understand the challenges that are faced by financial institutions when it comes to conducting KYC and customer due diligence, let's look at the three predominant stakeholders in any financial institution and then look at their specific challenges. So, number one, we have the compliance team, which is constantly under pressure from the regulators or the auditors because they need to prove controls over the applications that have been deployed, uh, you know, to to satisfy the compliance policy and or regulations. They need to be able to explain and justify the decisions. For example, why a certain transaction was approved or rejected, why a certain customer was approved or rejected, and to support those decisions, they need a comprehensive audit trail that captures all the events that took place to come to a particular decision. So essentially, their challenge is having enough control over the system or demonstrating enough control over the system that is being used for compliance, uh, having traceable solutions. So traceability is one of their challenge, and the ability to explain decisions or explainability. So traceability, explainability, and demonstrating control over the applications that are being used. Then we have compliance operations. Now, compliance operation are is a team that makes decision or qualifies decisions. These are also individuals who collaborate with different teams when they either cannot make decisions because maybe they are not qualified to, or because they don't have enough information. So their biggest challenge is to have enough information or meaningful information so that they can make decisions, and having systems that allow them better collaboration. Now, when it comes to IT and application owners, uh, their biggest concern or biggest challenge is identifying solutions and deploying those solutions which are scalable. As we previously spoke about, monitoring domestic transactions where the volumes are huge. Now, to be able to have solutions that are capable to serve a financial institution when such a need arises, or you know, when a financial institution grows their business, the volumes are going to grow. So their biggest challenge is to identify scalable solutions. and maintain them. They are also concerned about the integrity of data. Information security is a big concern or challenge for the IT team. Now, Accuity did a survey in 2017 to identify or verify some of the challenges that we just spoke about in order to focus our energies to develop better solutions for our customers. What we found from that survey was more than 75% of the respondents uh, found managing the cost of compliance challenging, at least fairly challenging. We also found that reducing manual effort or automation of repetitive tasks was challenging for most respondents as well. We also found lack of data uh, or lack of you know standardization to be a big challenge for our customers, and alignment between front and back office uh, was cited as a huge challenge by most of, of the respondents. Now, as I said, we do these surveys to better serve our customers. So our approach, I would like to describe our approach in four specific points. Uh, because the regulatory environment is changing, it's very complex and it's very uncertain. The solutions that we offer have to be highly configurable. So configurability is an area of focus for us, not only because different financial institutions, depending on the business they are in and the jurisdiction that they need to comply with, uh, have different compliance needs, but also within a particular financial institutions, you might have different departments having different needs. So having a configurable solution to meet such complex demands of our customers is important to us. Secondly, as we saw with the compliance team, their uh, biggest challenge is to have a traceable solution uh, and an explainable solution. Uh, that is an area of focus for us, traceability and explainability. We are also solving the data standardization problem by uh, supplying a single source of data. So be it sanction, PEP, negative media, enforcement, vessel, etc. Uh, we standardize the data, package it, and supply it to our customers to make their KYC and CDD more efficient. Lastly, from a technological point of view, uh, our solutions offer APIs for better integration with the systems within the bank, so that for example, back office and front office can talk to each other. So these are the four areas how Accuity helps financial institutions.
Sort of, sometimes an overly cautious approach by banks with respect to customer due diligence and screening can have the unintended consequence of excluding legitimate business and customers from the formal financial system. What, according to you, are best practices that banks around the region should follow to ensure a balanced approach?
That's a very interesting question, Shirish. Uh, this process by which a financial institution decides to not do business in a sector, region, or a country because they perceive it as too risky for their risk assessment is termed as de-risking. De-risking results in a withdrawal of services by these financial institutions from regional banks, thus removing their access to international finance. And this has a huge implication on trade and global banking. Rather than reducing risk in global financial sector, de-risking actually contributes to increased vulnerability by pushing high-risk clients to smaller financial institutions that may lack AML CFT controls, or it even pushes them out of the formal financial sector altogether. It also creates a perception that the de-risking bank has inadequate risk mitigation tools to distinguish between honest customers and criminal ventures. Accuity did a research in 2017 into the number of correspondent banking relationships by geography, which quantified the scale of de-risking by region. The research found a 25% drop in global correspondent banking relationships linked to de-risking. One of the factors that has contributed to de-risking is that the cost of compliance has grown and the risk-reward balance has become unfavorable for large banks. If we want to reverse this trend and begin to re-risk, uh, then the antidote will require more granular level due diligence and proper risk assessment to provide large clearers, large banks, with the confidence that they can deal with low risk business in high risk jurisdictions. The FATF recommends a risk-based approach where the financial institution identifies risk factors associated with customers. So customer background, AML system checks of the customer needs to be done, identification of political affiliation, country, the country of residence, country of incorporation of the customer, the nature of business activity, so it's associated with the industry that the customer is in, and the product and services offered to the customer and the product and services that the customer offers to their customers, the currency in question. So using this risk-based approach framework, FATF recommends identifying risk factors and then developing a heat map to identify critical processes and concerns to devise a step-by-step AML roadmap. Thus, there's a need to get granular with due diligence, and in turn, this will lead to greater financial inclusion and new revenue streams for the institution.
Finally, Saurabh, what are the latest technology tools available to banks to improve the process of due diligence and make it more efficient?
Some of the tools and technology that financial institutions have found beneficial uh, in improving the process of due diligence and achieving more efficiency uh, are artificial intelligence, machine learning, blockchain, and APIs. Manually validating customer databases against sanctions lists and other lists uh, can generate hundreds of thousands of alerts, and each alert may need to be assessed to determine accuracy, quality, and potential risk, which can significantly drain compliance resources. By applying AI statistical models, the amount of alerts can drastically be reduced and allow better prioritization of alerts. AI statistical models can also be used in analyzing patterns in order to predict a behavior. KYC is a notoriously labor-intensive and time-consuming process, as we all are aware. While automation has enhanced its efficiency, blockchain brings the potential for even greater improvements. Blockchain cannot remove the need to perform due diligence on a new and existing customer, but it could introduce a far greater level of trust and efficiency into the process. Blockchain can help mutualize KYC data internally and eliminate the need for clients to go through a separate KYC process for each product or service they subscribe from an institution, for example. So that's the use of blockchain. When it comes to APIs, they are they are the pipelines that allow different applications to talk to each other. They offer a seamless way to access data from an application, send data to that application, or request a service from another provider. Uh, Without a common protocol to automate data exchange, moving data or sharing information between different applications or different systems is a very manual process, and it's time consuming as well, which brings down the KYC process or slows down the KYC process. APIs simplify the process by providing the missing link to seamlessly integrate data or intelligence directly into the bank or a third-party system. APIs can accelerate connectivity, drive automation, and boost efficiency while supplementing human decision-making, helping organizations strike the optimal balance of human intervention and automation to achieve business goals. So these three, in my opinion, are the technologies and tools that can help financial institutions that are not utilizing them to its fullest potential. Uh, you know, it can help them reduce the manual effort, improve the process, and increase efficiency.
Saurabh, thanks so much for these very interesting inputs. And with that, let's move on to our final speaker for this webinar, Dr. Srinivas Yanamandra, Chief of Compliance at New Development Bank, China. The New Development Bank, as you all may know, is a multilateral development bank established by the BRICS states, that is Brazil, Russia, India, China, and South Africa. We have asked Srini to give us a socio-economic context, especially his understanding of the evolution of the legal and regulatory thinking within developing states, the move towards greater digitalization and building unique identifiers for its citizens for better access to financial services, as well as the support ecosystem that is being provided by organizations such as the United Nations and the World Bank. Srini, at the outset, could you outline your views on how developments in the digital world interact with customer due diligence processes?
When we talk about digital and physical world, I would like to talk about two important things. Digital in a CDD world, CDD in a digital world. The first phenomena, digital in a CDD world, refers to how technological developments assist the current CDD processes which are carried out in a manual or in an automated context. The new age technological developments, starting from optical character recognition, which can transmit data from the application form directly to the database, including the new age technological developments such as facial recognition that enables performing face-to-face KYC through video verification. Both the OACR route as well as the facial recognition advanced route both constitutes the digital evolving phenomena in a CDD world. Now coming to the second phenomena, CDD in a digital world is another way of looking the KYC in a different context. When the entire transaction is undertaken in a digital context, CDD refers to establishing the identity of a person using different parameters. Your identity is no longer only can be determined by a number or a card. Your identity is a product of several digital parameters. Your online persona, your social media presence, your online footprint, all these will now transform the concept of identity to a different level. It's no longer digital identity, it's about digital profile. AML professionals, typically from banking institutions, mostly focus, and sometimes largely due to the regulatory regimes, on the first phenomena, that is digital in CDD world. It makes their life easy. It helps their customer acquisition by their respective banks. But new age fintech firms are focusing on the second concept, how to establish digital profile, and that becomes somewhat tricky. Regulations are still evolving. Risks are unknown in such profile building. Customer concerns such as privacy are still being debated. But the discussion on digital and CDD world should, in my opinion, incorporate both these perspectives if we want a holistic discussion on this topic.
Thanks, Srini. Can you speak about some of the international developments with respect to CBD in an increasingly digital world?
When we talk about CDD in the digital world internationally, and especially observing the trends in the development banking since past few years, I'm tempted to talk about the 17 Sustainable Developmental Goals, SDGs, which are developed by the United Nations as part of their development agenda. SDG 16, which talks about peace, justice, and sustainable institutions, aims to promote peaceful and inclusive societies for sustainable development, providing access to justice for all and build effective, accountable, and inclusive institutions at all levels. Now, within this broader SDG, there is a specific SDG 16.9, which talks about identity, and it also says by 2030, the goal is to provide legal identity for all, including birth registration. Now, identity is massively important in the context of digital world, and this is where the CDD in digital world takes away the basic task from identity verification to identity creation. It is important because it provides the ability to prove who we are as a provider of security, and it can also form an important part of our ability to exercise our fundamental rights. Now, this is very important when we look at the cases like those of the stateless people who often lack documentation to establish who they are, leaving them open to discrimination and abuse and thereby to financial exclusion. However, there are certain dangers with the design and introduction of the digital identity systems, particularly in the way they are currently being designed as large, singular, and nationwide identity projects. If the stakeholders fail to consider some of the risks, these digital identity systems can themselves threaten human rights and also particularly the right to privacy. Perhaps more than any other single SDG, a sweeping range of initiatives have emerged from the SDG 16.9, or these national identity systems are basing their existence to this SDG. For instance, we have this World Bank's Identification for Development Initiative, ID4D, which has attracted support from philanthropic funders such as the OMDR Network and the Bill and Melinda Gates Foundation. There is another initiative internationally, ID 2020, which is an alliance between governments, NGOs, and the private sector. The GSMA, the industry trade body for the telecommunication companies, has emphasized the role of SDG 16.9 in their own work on digital identities. And then there is this World Identity Network, which argues that it is only through the use of technologies such as blockchain that this SDG can be met. The private sector too also has a role, from the big biometric firms through to the startups like Aid Tech with their blockchain-based digital identity creation projects. Now, what does this vast mixture of industry bodies, development players, and major donors want from this SDG 16.9? The scope itself is going beyond what is there stated in the SDG itself, that is legal identity, to a more complex form of digital identity and singular ID systems for the entire population. And this is exactly the problem that AML professionals at some point in time will be confronted with. While we have certain challenges in the context of CDD, when we talk about in a offline or in the context of a manual or in the context of an automated form, the risks are basically only in terms of verification and also establishing the identity. But when we talk about the digital world and when we talk about these digital identities, the problem goes beyond the process of creation of the identity. And this is where I think international developments from the developmental banking context are looking out for some solutions and also identifying and addressing some of these challenges. So I think I would like to distinguish the context from the developmental banking perspective and try to say that this creation of digital identity is as much important as the identity verification of CDD, which we normally in the context of automated and the regular banking context talk about CDD.
Identity verification is one of the basic necessities for CDD. How does technology reconceptualize the challenges of identity verification, especially in a digital world?
When we talk about CDD in a digital world, I think I need to outline three important challenges that these latest technological developments bring about. The first one, I think, is in the context of the National Digital Identity Project itself using biometrics. Here, for instance, in the context of Aadhaar, the National Identity Project of India, the biometric-based one, we already have seen challenges such as legal aspects surrounding privacy, personal data protection, as well as the reliance upon the new age tech regulations, such as those relating to e-signatures. In these projects, I observe there is a lag between how different players are approaching CDD space. Tech players are fast moving ones with biometric enabled digital identity systems. And catching these tech players is the pace of the policymakers, such as law enforcing authorities or the law making authorities, for instance, who are incorporating latest developments such as e-signatures as non-reputable means of authentication. And in the last in the race are the regulators who are still trying to ascertain all risks before they give heads up to these tools for CDD verification. And it is not without valid reasons that regulators are concerned about the feasibility of tech developments and their impact on the identity verification and CDD process. I think one particular concern is about using digital identity as foundation for several token currencies. This has led to the proliferation of risks of anonymity. Tech folks might say that these tokens are pseudonymous but not anonymous. But still, the risks in using a totally online identity creation and verification is far from authentic. It has risks of anonymity still. And then we have now an emerging problem of what is known as deep fakes. Banks and payment service providers are currently racing out to roll out voice services combining artificial intelligence and natural language processing capabilities to enable users to utter commands instead of entering them manually through a keyboard. Now, if we take a step back and use these tools for digital identity-based user verification and assessment, and not only for customer service, then we come across a new age CDD fraud known as deepfake. That is a voice or an image appearing exactly like the original and can pass the CDD test, but through fraudulent means. So the CDD in a traditional world, we have the problem of these forged identities and fraudulent identity verification processes and the lack of documentation to show that we have actually met the person and verified their identities. These are the traditional problems and the traditional way in which a CDD in a manual or an automated context could be come to a question or about a scrutiny when later it turns out that the identity verification is not as per the standard. Now, when we extrapolate this digital identity to a different context or to a new tech world, now we have got additional challenges in terms of the identity creation and verification. And these additional challenges are ones which are related to the traditional topics such as privacy and personal data protection. We have legal challenges such as establishing legally valid mechanisms such as e-signatures. And we need to also think about new technological frauds such as deep fakes. And all these three challenges would add up to the new set of challenges which we already are aware of, to the challenges which we are already aware of in a regular CDD context without the technology proliferation.
Finally, Srini, what according to you are the trends in regulatory response to CDD-related challenges, especially from BRICS countries, since that's the scope of coverage currently?
As I said earlier, the regulators are also observing the trends in the technology space and are articulating their response. Day in and day out, there are several technology companies which are having a very fast pace innovations that they are bombarding with the bombarding the financial institutions with. Each day, the new innovations, new groups of concepts are at the doorsteps of the banks and financial institutions. But regulators are taking a cautious approach and are usually trying to create regulatory frameworks that are aimed at balancing risk and also innovation. Now, if I have to bucket this regulatory response, I will try to do that in three different ways in which regulators are articulating their response. The first one is the regulatory communication. Communicating that there are risks associated with digital technologies and warning the financial institutions to be mindful of them. I think this is the first approach every regulator across the world, including the BRICS countries, are trying to do. And the communication nowadays is taking a structured format through regulatory sandbox approaches. Under these approaches, regulators are saying they're receptive to new innovation and are willing to allow institutions to test any of the new innovations, including in the area of CDD, in a limited scale. This allows firms to structure their CDD innovation strategy in accordance with the regulatory priority. I think there are some examples which we can cite in this regard. The one, the forerunner being the Monetary Authority of Singapore, which has started creating the position of a chief fintech officer and trying to spur the innovation within the financial industry and engaging with the industry in a big way. And within the BRICS context, I have seen a similar kind of an initiative created by the South African Reserve Bank, which has created a fintech unit. And this fintech unit is in the top of all regulatory innovation engagement with local financial institutions, technology companies, and they're trying to understand the technology in order to ensure that their regulatory response is nuanced and also conducive to the long-term financial stability. Now, apart from communication, regulators are also trying to experiment. So this is a second regulatory response, regulatory experimentation. Regulators nowadays are not seeing these innovations as useful only to financial institutions. Indeed, they're using these innovations to address some challenges even in the regulatory interactions that the institutions keep engaging. For example, I have seen a project under the Central Bank of Brazil's innovation strategy, wherein the project the Central Bank of Brazil has conceptualized in collaboration with the securities regulator and the insurance regulator. Now, this project is for the purpose of ensuring that there is a distributed ledger whereby the due diligence information for any new licensee who has to get regulatory approvals across various regulatory agencies. This project allows, if you are indeed in need of any kind of a regulatory license from any one of the regulators, the project peer using the distributed ledger technology will allow you to submit such kind of an information to one of the regulators in the first place, and this information through the distributed ledger gets shared across the other regulators. I think this proof of concept and the pilot study that the CBB, Central Bank of Brazil, has undertaken offers some good insights as to how a progressive regulator, if he watches the regulatory innovation happening in the industry, could use these innovations even for improving the regulatory response to financial institutions. Even in the recent announcements that I have been following, there is a mention about a draft regulation and permitting of the video-based KYC, even in the Indian context. I hope this draft guidance would be taken up appropriately and the experiences will be fine-tuned or the experiences will be used to fine-tune the regulatory response, which will be a step forward in the CDD in the digital world context in India. And the last one is the response of the regulators in the context of response of the regulators. The last approach is basically the regulatory collaboration. The learnings of these regulators are frequently being shared across regulators, and one key forum, as we all know, is the Basel Committee and the Financial Stability Board, the regular publications under which they keep outlining what are all the trends that are happening across various industries, across various countries. And if I were to mention one such report or one such publication, I would give a reference to the recent BAS annual report, which talks about big tech in finance. I think this is a must-read report for anyone who is willing to understand what's happening in digital space, what's happening in fintech, and how regulators are trying to address the risks associated with respect to the fintech innovation. That report provides the risks and challenges of when big data and analytics are enabling fintech companies to enter into this space and how these are challenging the traditional financial models. So if I have to sum up, the regulatory response is in three phases. The first one is communicating that there are risks associated. The second one is experimenting through different approaches. And the third one is inter-se coordination between regulators to ensure that the latest tools and techniques are being shared and best regulatory response is arrived at.
Srini, thanks for your inputs. We will now move to the Q&A session. We have just a few minutes remaining for this session, so we can possibly take a couple of questions. The first question that we've received is, what are the main differences and subsequent implications that you see around the region in CDD practices across different classes of banks, such as public sector, private sector, community banks, and mobile wallets? Saurabh, may I request you to take that question, please?
Sure, Shirish. I hope everybody can hear me. And thanks for the question. This is something that I also presented in my in one of the questions that you had asked regarding the risk-based approach earlier. So before I answer this question, it's important to understand that there is a general sense of improvement across the APAC region, and that is due to the increased regulatory scrutiny, FATF evaluations that we have seen, and the rise in technology tools that are now available. So it's now important to understand that each bank, irrespective of the region, differs in their CDD practices and the policies, and it's based on multiple factors. One of the factors is the kind of business they are in, and the focus as a business that the bank has, and the risk appetite that comes along with it. So I have divided the differences into three different buckets. Number one is the regulatory environment. So the CDD practice of a financial institution, be it a community bank, private sector, public bank, or any other institution that is regulated, highly depends on the regulatory environment that they are in, or the jurisdictions that they need to satisfy. And clearly in this region, as we see Singapore, Hong Kong are one of the regulators that are very proactive, and hence banks in these regions have better CDD processes comparatively. Banks who are in, or businesses who are in involved in cross-border trade, for example, where they have to partner with financial institutions in the US or in the West, would also like to have CDD practices in line with the standards that are set in that jurisdiction, because the implication of not doing that is what as I defined in my one of my slide, is called de-risking, where the financial institutions from the US or Europe would cut ties with that bank, and the bank loses business. So again, to reiterate, it depends on the kind of business and focus that the financial institution has. It also depends, when we compare banks versus the new age fintech companies like wallets. Wallets have a slight advantage when it comes to technology. These are technology focused businesses. They do not have the burden of legacy processes and legacy systems. So they can invest highly in new age technologies to improve efficiency I'm not saying that banks are not investing into that, but it's easier for a new age fintech company to do that because they don't have the burden of a legacy process, and they are therefore able to utilize these technologies to a greater effect. It also depends on people. So most important aspect of any AML or compliance program within any institution that is regulated is the appointment of the right set of people. As Srinivasan mentioned, regulators, in certain region are appointing a chief um, regulatory officer, or in similar lines he said something. So that is also important. So in certain regions you have a talented pool available, or the focus is to develop these compliance people, uh, and that's why they are able to keep up with the regulations. And some regions, if they don't focus on the right people, then they are not able to. So in my experience, working with banks and non banks alike in the region, the primary difference in CDD practice arises from the fact that they have different business areas and business focuses. I hope that answers the question.
Right. Thanks, Saurabh. Saurabh, there's one more question actually come for you. It says, what is it that you would like to see evolve in the regulatory space to enable a better balance between inclusion and compliance in the area of mobile wallets and fintech? I know that Kathy touched upon this in her presentation some time back, but great to get your views on this as well.
So I think regulators are observing the trends, as Srinivasan was mentioning. So regulators are essentially observing new technology businesses coming through, and assessing the risk, and then trying to come up with regulations. If you ask my personal opinion, mobile wallets and any fintech company, what I would like to see happen is the investment in technology, and greater awareness in these technology companies when it comes to the knowledge of compliance. So greater investment not only in technology, but also investment in the compliance functions. Banks, because of traditionally they were regulated, they have a talent pool of compliance professionals who understand regulations, and the complex world of regulations, and are able to then formulate policies. Some of the new wallets or fintechs may not have access to that pool, or maybe inclined towards a checkbox approach, perhaps. What I would like to see is a greater sort of awareness when it comes to regulations and compliance in the future.
Thanks, Saurabh, for answering that question for our audience. Now, we have one more, which also incidentally is again for you, and this is about sanction lists. So the question says, with regards to sanction lists, how can technology be used to extend the checks on close relationships with listed parties? Would you like to take that, Saurabh?
So if I can reiterate the question says, is it related to the related parties on the sanctions list? Is that the question?
That's right.
Right. So we are as a technology company investing in as processes to cater to that. One of the things that uh, I mean, it's one of our research areas, plus the solution that we offer is identifying and assigning risk to each entity on a particular list uh, by comparing the related parties, or comparing the relevance of that entity to the bank in question. So since, I mean, I'm not able to demonstrate this, but uh, I think the idea is for data providers to research on related parties. There are certain guidelines available from OFAC, for example, the OFAC 50, where a sanctioned entity on the list, if it's a company, for example, any subsidiary having 50% or above stake
any subsidiary where the sanctioned entity has 50% or above stake is by default sanctioned. So it's for data companies to add that information into the data watch list, which we do. Plus also finding out how connected this individual entity on a sanction list or a PEP list or a negative media, how connected this entity is, and then assigning a risk score on the watch list. And then it depends on the bank to formulate a policy based on that risk scoring. So it's on the data provider to do some additional research, but it's up to the bank to use that additional risk scoring or research based on their risk appetite.
Right. Thanks. Thanks a lot for that, Saurabh. Well, that's about all the time we have for questions today. We are already, I think, a couple of minutes over time. We have many more questions in the queue, and I would like to say to the audience that we will forward them to our speakers and hopefully come back to you shortly with specific answers offline, which we will email to you. The slides and supporting material for this webinar will also be circulated in due course. And we will also shortly circulate a web link to an online assessment, which you may attempt if you would like to receive a participation certificate co-branded by Fintelekt and ABA. So thank you so much for being part of this webinar. Special thanks to our partner, the Asian Bankers Association, as well as to our speakers, Catherine, Saurabh, and Srinivas. And thanks to all of you for listening in. Have a great day.